So in this first segment, we're going to talk about retirement plans and the type of characteristics they have. But let's start by understanding what we mean by a retirement plan. Think of something you buy at the store. There's an item and it's in a packaging. And that packaging can be all sorts of different types of packaging. It could be a box, it could be a tube, it could be wrapped in plastic, it could be in hard plastic. So you've got the characteristics of the packaging, and that hasn't told you what's actually in the package. That's the way to think about retirement plans. Retirement plans are a package. It doesn't tell you what you do with the dollars you put into the package. Those are the investments. It just tells you what the benefits and characteristics of the retirement plan itself are. We're going to talk about three types of retirement plans. And the first is an IRA, or individual retirement account. Now, there are a number of characteristics specific to an IRA. And the first is how much money you can put in. And that is a maximum this year, in 2020, of $6,000 unless you're over the age of 50, in which case there's what they call a catch-up, and the catch-up allows you to put an extra $1,000 into it. So $6,000 if you're under age 50, $7,000 if you're over age 50. Now, what's the benefit? Why are we putting money into an IRA? Money that goes into an IRA is pre-tax money. What's that mean? So if you earn $50,000 a year, and for argument's sake, you're paying 20% of that in actual taxes. That means you earn $50,000, you give $10,000 to Uncle Sam, and that leaves you with $40,000. Well, if you take $5,000 and put it into the IRA, you will tell Uncle Sam that you didn't earn $50,000, you only earned $45,000. So now you'll pay taxes on $45,000, which is $9,000 instead of $10,000. So you saved an extra $1,000. That's $1,000 that's in your pocket. You can use it to spend, you can use it for savings account, or you can put that into your IRA. And if you could only have afforded $5,000, now you can actually put $6,000 and reach the maximum in your IRA. Next characteristic is actually 3 dates that you want to remember, or 3 ages. When you turn, before you turn 59 and a half, after you turn 59 and a half, and when you turn 72 and a half. So let's talk about those. If you pull money out of an IRA before you're 59 and a half, you will pay taxes on that, but you'll also pay a penalty, a 10% penalty. Now, there are some situations where you get an exemption, but the thing to remember is that you're not supposed to pull money out of your IRA. It's long-term savings. And so they charge you a penalty if you pull it out early. Once you're over 59 and a half, you no longer pay the penalty if you pull money out. You still pay taxes on it, but there's no penalty. And then finally, after the age of 72 and a half, you must start to pull money out of your IRA. It's called the required minimum distribution, and it's based on actuarial tables. The IRS publishes these tables, so do most broker-dealers, but you'll take a fraction of the money you've saved into your IRA and make you pull it out and pay taxes on it. The next kind of a plan that we're going to talk about is a Roth IRA. Same contribution limits as an IRA. But the big difference is that with a Roth IRA, it's after-tax money. So our example, you're earning $50,000 and you put $5,000 into your Roth IRA. You still tell Uncle Sam that you earn $50,000 and you pay all $10,000 in taxes. So that extra $1,000's no longer there. So why would you do that? Because the money in a Roth IRA is not required to be pulled out at any point in the future. And all of that money grows just like the IRA, tax-free. And with a Roth IRA, it's actually tax-free because if you pull it out under normal circumstances after you're 59 and a half, you won't pay taxes on it. whereas with that IRA, you're going to end up paying taxes. So there is a benefit to the Roth IRA. Now, the real question is, so which one should I invest in? And that depends on a couple of things, but here's the basic point that we've learned. We did a study where we said, we're going to put $5,000 into the Roth IRA, but actually that means you can put $6,000 into your IRA because you have that extra $1,000 you didn't give to Uncle Sam. So over 30 years, that's an extra $30,000 plus the compounding on how you invested that. Presumably you invested in the exact same way, so they both grew the same way, but the IRA is going to grow faster because of the extra money in there. Now, at age 72 and a half, you have to start pulling that money out. If you don't pull money out of your Roth IRA, we calculated that by age 83, you now are at break even. The same amount of money is in your IRA as your Roth IRA. Okay? So, the interesting thing is, what's the average life expectancy for somebody living in the U.S.? Between 82 and 86 years old. In other words, by the time you brought it down to the size of your Roth IRA, you're getting to about the point of time where you're likely to pass away. So, which is better? Well, it depends on some things now. How long you live. Whether you needed to pull money out of your Roth IRA. If you don't need to, but you are required to out of your IRA, you're going to end up better off in the end with your Roth IRA. But if you need to pull money out of your Roth IRA, now they're both going down, but you have less to begin with in the Roth IRA. Now, granted, the money coming out of the Roth IRA is not getting taxed, and the money coming out of your IRA is. More likely than not, at a lower tax rate than when you were working, but even ignoring that, what you're likely to find is in the end, because you were able to save a lot more, you're better off in an IRA. Now, if you take extra savings beyond the Roth IRA, and you've got extra savings that you've put away elsewhere, then maybe the Roth IRA is better. So what's my point? My point is, this is why you have consultants and advisors to talk to, whether it's an investment advisor, a financial planner, or a tax advisor. You want to bring these people in to discuss your situation because it's going to be different from the next person's. The third type of a retirement plan is commonly known as a 401k. This is what we call a corporate plan. In other words, IRAs, Roth IRAs are set up by individual people. 401ks have to be set up by a business. It's got the same requirements as an IRA and same characteristics in that it's pre-tax money, and that at age 72 and a half, you have to start pulling money out. The big difference in a 401k from IRAs is the amount of money you can put away is much greater. In 2020, an individual can put $19,500 away into a 401k, and when they're over 50, they can add an extra $6,500. So it's a total of $26,000 instead of $6,000 or $7,000. But in addition, the company can also make contributions on your behalf. And with that combination, the maximum is $57,000, or if you're over the age of 50, it's a total of $63,500. So you can put a lot more into a 401k. Now, there are all sorts of rules and restrictions that get into calculating how much you can do, and then again, that's where you're going to have to go back to your advisors. But the bottom line is you can put a lot more in. Now, let's explain the corporate matching or the corporate contribution. You have what's called a match or a profit share. A match is a percentage that is matching what you put in. So if you don't put money into your 401k, you don't get the match from the company. If they do a profit sharing, then everybody who's eligible gets that profit share whether they put money in or not. But in either case, it's free money. It's not your money. It's not from your earnings. It's from your company's earnings. They're helping you save. You want to take advantage of that. So those are the three types of plans. We haven't talked about other types of plans, and we haven't talked about the investments. So let's hit on both of those real quickly. One, there are all sorts of other types of retirement plans. There's simple IRAs, SEP IRAs, pensions, and there are various types of pensions. There are all these specialized types. And the point to know with them is that when you start to look at putting money into a savings plan, if you're self-employed or if you own the company, you want to look at all these extra types of plans. And that means talk to your advisors, because they have all sorts of special rules, but take advantage of them. The other point is about the investments. Notice we didn't talk about the investments. That's what's in the wrapper. You can invest in all of these plans in just about anything you want. Stocks, bonds, REITs, mutual funds, insurance, ETFs. There are very few things that are restricted from retirement plans. There are a couple, but by and large, you can invest in anything you want. So when somebody says to you, I have an IRA, all that tells you is that they have a tax savings plan. They haven't told you how they've invested it. I hope you found this helpful. Stay tuned for our next segment on retirement planning.